Hello and welcome to today's presentation, which is called Bear Trap. That's exactly what I had been cautioning you, not to be shaken by intraday volatility if it comes, which support is going to be stopping it. I had been giving details to clients and they had benefited through capturing the recovery of the lows while having prior longs protected at a reasonable trailing stop loss level to lock in open gains, and that concerns both swing and intraday clients. Thank you for liking these videos and subscribing to the channel. You know my rich data feed, what I do for clients on the YouTube page as well. Starting with yields, we are seeing them largely not go anywhere in the last couple of weeks, and I would caution you to the short end remaining more so elevated than the long end. Currently this is not biting, and as you can see from the caption, we are likely to see creeping deterioration starting with the job market in the following not just unemployment claims or non-farm payrolls, headline and revisions. It is going to be reflected with the cost-cutting effects of those. And what else could I say? Tariffs, these would heavily influence consumer spending and corporate profitability, so that's somehow hanging as a Damocles sword over the rich valuations that we are experiencing. However, they are not breaking down. The dollar is recovering pre-market. Japan had seen quite high inflation, surprise. Japanese government bond yields are rising, but the central bank is not panicking, and my prior call for orderly appreciation, not rocking the risk-taking boat in the Japanese yen, nothing that would influence negatively global markets the way it did last August. This is still holding true. I will not be diving into gold or silver or oil. Let's just say that the daily calls had been working out well for clients yesterday too. Let's though stop with this commented chart as regards S&P 500. We had seen breakdown attempts. That was in line with my calls rejected, and it kind of feels as a retest of the breakout above, say, early October or early January highs, or mid-January highs. Where does it leave market breadth indicators? Neither deteriorating nor rising, quite nicely primed and rested. One look at the tech to S&P 500 ratio when it comes to their respective ETFs reveals that there are still some inflows into tech, and I will be linking as well not just to prior timely presentations within this one, but as well to the DeepSeek one where I had talked the quite long-term ignored technological advantage that China had gained in overcoming the chip import restrictions, and the fact that truth had been somewhere in between when it comes to how much computing power it took to emulate the top AI models by them. You know that I had been covering the STEM graduates' advantage that they are enjoying and so on, which bodes well for their technological sector. And you know that one of the driving factors of Baba Ascent had been the speculation whether it owns DeepSeek or not, or at least partially, or what is the relationship to that. And I had alluded to that within the past week in some presentation. The other ratio that I'm bringing you is the financials one, and financials, don't they look a bit rested to you here relative to S&P 500? Having a look at the sectoral overview, we see that yesterday was a heavily risk-off day, yet look where S&P 500 had closed. So thanks again for liking these videos and subscribing to the channel. One more, and this is the final slide with charts on. You see that yesterday's selling did not coincide with a dramatic increase in the volatility index at all. The volatility crash is just continuing. And that has consequences for risk-taking, asset prices, and the current price trajectory that we are seeing in S&P 500. My join page to help you select what's right for you based on what and how you trade. Revisit the site. Thank you for getting to know me pretty well. The rich background spanning many sectors and functions. Obligatory disclaimer, and let's talk soon.